Greetings, members, one and all of the Salivation Nation. Inflation is driving gold and silver down. Let's explore. Now that seems like the exact opposite of what it should be doing, but the recent evidence points to indeed that being the case. Why in the heck is silver and gold not breaking out dramatically to the upside with all this inflation and all of this economic instability that we are seeing? And make no mistake, there is economic insecurity and instability at this point for sure, all derived around not only inflation but the things that are driving it, and that is the biggest thing would be the Federal Reserve printing a lot of money. 40% of all the M2 money supply ever created was done in the last 2 years. Let that sink in, folks. That has the obvious effect of inflation. That's the biggest driver. Then you have supply chain issues that have been happening since COVID. And then you have the idea that fuel prices are going up, mostly because of domestic drilling has been largely stopped by this administration. And then, of course, you can also add to the addition to that of what's going on with Russia and Ukraine. That does play a role, but it's not the biggest role into why fuel prices are so high. Nonetheless, that is weighing on silver and gold, especially silver. Gold is really not that far off. But we're going to be referencing an article here from CNBC that talks about what's happening to gold and silver today. And in fact, before we get into that, let's take a look at the numbers here. And before I explain what's going on with the numbers here, first I want to remind you that I do post videos on a daily basis. And so if you don't see a notification, even though you may have pressed the notification bell, I encourage you to do that and make sure it's enabled on all your devices, as well as if you don't see a video come across your subscription feed, I would encourage you to bookmark the page, the channel page, and to check out the video there, because I do post videos on a daily basis. So this is where gold and silver are at right now. Gold is down $4.60, not a big drop, a little bit, about a quarter of a point drop there. And silver, though, is down fairly, we're talking over 1.5% drop for silver, well below $22 again. It just can't seem to break out above $22 and change here recently, and that's frustrating a lot of people. I think a lot of that has to do with the supply chain issue and the lack of demand for the metal on the industrial sector because of these supply chain issues. Some things cannot be manufactured because of other areas of shortages. Platinum is down dramatically. It's taken the biggest hit to under $1,000 again. And both palladium and rhodium are down. Red all around. Gold to silver ratio is now above 85 again. So this is happening here ahead of the report of the U.S. inflation data. And so let's see what CNBC has to say about this. Gold prices fell on Thursday as elevated U.S. Treasury yields and a firm dollar dimmed bullion's appeal in the run-up to U.S. inflation data that could strengthen the case for an aggressive policy tightening by the Federal Reserve. So in other words, they are bracing for higher inflation, maybe higher than 8.3%. And if you remember, not too long ago, I predicted that we'll see lower inflation data. I'll get to that in a moment. The ECB signaled that they're going to start raising rates in July and continue to raise rates. It has gold trading a little lower. Feels like there's some risk off in the markets that's spilling over into gold too. Plus, bond yields are up a little bit, said Rob Heppercorn, senior market strategist at RJO Futures. The ECB said it will end bond buys on July the 1st and raise rates by 25 basis points later this month. It will hike again in September and may opt for a bigger move then if the inflation outlook fails to improve. U.S. yields rose, increasing the opportunity cost of holding non-yielding gold while the dollar firmed, making gold less appealing for overseas buyers. Tomorrow's inflation print has gathered substantial attention, but with the next few Fed hikes set in stone, the immediate relevance of data releases is limited, TD Securities wrote in a note. Instead, market participants will be honed in on any information that could inform the Fed's decision-making process post-September. The core consumer price index is expected to have risen 5.9% on the year, with an annual rise of 6.2% in April, according to a Reuters poll. That's it. So that is on the year as opposed to year over year. A little bit different how they measure that, but the CPI data due Friday could offer clues on whether the Fed will continue its aggressive tightening in the second half of the year. So it'd be kind of interesting to see how those numbers pace out from the beginning on the year as opposed to year over year, because I predicted that we may see numbers as low as 7.9% year over year. And we'll see. I don't think it'll be much lower than that, but I think it could fall to that. And they will utilize that, and the media will grasp onto that and make it sound like that, hey, maybe inflation really is transitory. But when you measure it compared to where inflation was last year at this time, which was starting to increase and creep up, it's really not much lower. In fact, it's higher than it was. In fact, that's just it. When you take a look at the things that the dollar does, the dollar, by design by the Federal Reserve, increases in the loss of value by a target of about 2%. Sometimes it's a little bit lower than that. In fact, I think during the last year of Trump's presidency, it was at 1.4%, because really the effects of money printing really hadn't taken their toll yet. But nonetheless, it is the target of 2%, which means that by design, the dollar is losing value at a dramatic rate. And, well, not so dramatic if it's 2%, but now it's even more. So it's never going to go the other way around. Just it's not going to happen. So the damage is already done from the higher percentages to where it is. So if the slow of the increase just means that the baseline is shifted, so that it may sound like that things are getting cheaper when really they're still getting more expensive. Just the rate of increase in the expense is not as much. So it's all bad news all around, no matter how you look at it. Notwithstanding, the media reaction to that will be of such that things are turning around and it's not so bad. And so that will have an effect, a psychological effect in the markets, and gold and silver will go down. This article is basically stating something that I really didn't think about, but it does make sense, is that if inflation does stay the same, or is only marginally lower from the year over year, or even if it goes higher, that will just bolster the case for raising rates at an aggressive rate, which it pretty much baked in anyway. And so that is going to mean that the dollar will probably strengthen, at least in the short term, and that the bond yields will remain high. So in other words, either way you look at it, at least in the medium and short term, we're probably going to see gold and silver remain lower. And, it's frustrating to think about. It's like, what is going to give here in order to see these prices? Is it going to take more inflation, or maybe it's the fact that, these rate hikes, they're putting all this faith in the Fed that I don't think should be there. Really, we should have faith in gold and silver as far as wealth preservation devices. In fact, many of us and many people out there's a lot of new stackers that are coming to the fray that are accumulating gold and silver. But I believe we're going to see, if we don't see them tank, and by the way, I think if it does go lower, we could see gold and silver tank because of that psychological aspect. However, if the inflation is high, they've only really done, that one rate hike, that 0.5% rate hike. That was a real big one. They did a quarter, I think, before. And so they feel like they got a lot of room to move to keep inflation in line. And that is the goal here. But employment could suffer. And the employment numbers, the next time they come out because of this, if we see it fall below, like what the ADP numbers showed before, then we'll see gold and silver break out. because that's where the real fear will begin. It's really all about employment when it's all said and done, because if you have strong employment and you're giving salary increases, cost of living increases, well, inflation doesn't matter to the average American. But notwithstanding, wages are not keeping up with inflation rate. For instance, if inflation is at 8.3% and somebody gets a 5% raise, that's a 3.3% pay cut when it's all comes out in the wash. And that's just the official numbers, folks. Keep in mind, inflation is really worse than what they're saying. It's just they're measuring it in a different way. And you have to take a look. And the producer price index is the number that gives you some hint to that, because it's always higher than the consumer price index. So very interesting indeed. That is where we are at in this situation today with the markets. And again, this data that are due, we'll find out and see what they have if they continue its aggressive tightening in the second half of the year, which they pretty much already said they were going to do that. And it'll be very fascinating to see where it plays out and whether or not I would be right or wrong in my previous video in prediction of what's going to happen tomorrow, Friday. So there you go. Let me know what your thoughts are in the comment section below. According to CNBC and other analysts, it looks like that inflation is going to be pushing gold and silver down, no matter how it's put out there. I'd like to extend a multitude of gratitude you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.